U.S. inflation came in hot for January. And of course, that raised fears that the Fed won't cut interest rates this year. We're joined now by Omodunbi, chief economist at Huntington Private Bank. Thank you very much indeed for joining us. You note that there were some factors in January that may have inflated the number. Walk us through it, if you would, please.
Sure. Thanks for having me, Andrew. So inflation came in worse than expected, like you said. Headline inflation came in at 0.5%. This was up from December. It was also the strongest pace since mid-2023. Core inflation was also worse than expected. So we saw a broad-based increase in prices, energy, food. Egg prices went up 50% on a year-over-year basis, used cars and trucks. But we tell clients and folks to take caution when looking at the January inflation report. There are a few factors that could have resulted in a stronger than expected January inflation print. First, many businesses changed prices at the beginning of the year. That could have contributed to the hot inflation report. Also, the BLS, the agency that produces this data point, they do a seasonal adjustments recalculation at the beginning of every year. And that could also have contributed to the hot inflation print. So one data point doesn't make a trend. We tell folks to wait till you see other months what happens in February and March in order to get a fuller picture of the inflation trajectory. However, inflation hasn't really improved over the past year, so that will be very disappointing for the Fed.
I know. I was discussing with colleagues earlier, Deadpool, the superhero, and it's not that he can't be killed, but he regenerates apparently, and inflation seems a bit like that in the U.S.
No, Andrew, that's a great point. Inflation in January 2024 was 3.1%. Last month was 3%. Core inflation has also been sticky. We're seeing some stickiness in core services, in shelter. And this will be a concern for the Fed. The Fed would want to see much better inflation reports for them to even consider cutting rates. The Fed has a 2% inflation objective, and given just the slow progress in inflation over the past year, and also the solid labor market, the Fed will be in no rush to cut rates.
Maybe we could put up an intraday chart for the U.S. 10-year bond yield, because we did see bonds drop in price, yields go up, and of course that's not great. If it persists, it increases borrowing costs potentially. So the bond market initially seemed worried here.
No, absolutely. We can continuously see investors reprice their expectations for Fed rate cuts. It's a murky outlook. There's been several announcements about tariffs. Those could be inflationary. There have been several policies that could also be inflationary, such as restrictive immigration policies. That could weigh on the labor market, result in a tighter labor market, and puts upward pressures on wages. We continuously, over the past couple of months, we've seen investors continue to reprice their expectations for Fed rate cuts. Currently, markets are expecting about one rate cut before the end of 2025.
Eggs, obviously, a lot of people griping about that. The White House even says it's going to do something about the price of eggs. Not sure what exactly they can do. But shelter accounted for a big chunk of the increase in prices.
Absolutely. So shelter is the biggest component of inflation. It accounts for about a third of headline inflation and about 2/5 of core inflation. The stickiness of shelter inflation is really linked to the housing crisis, a lack of inventories in the housing market. The same issue also in Canada. There's a housing shortage, and that has put upward pressures on house prices. It's also put upward pressures on rents. Now, the great news is that we've seen slower rent growth over the past year. So, that should translate into better shelter inflation through 2025.
What do you think? Is inflation just going to lurk around for the coming year?
Yeah, I think it's going to be sticky, over the next couple of years, right? So, we don't think inflation is going to get back to the Fed's 2% objective for a couple of years. Again, demand is solid. Economic growth last year was 2.8%. It's a strong U.S. economy. We're seeing solid demand for goods, solid demand for services. That's putting upward pressures on prices. And also inflation expectations rose in recent months. The University of Michigan sentiment came out last week, and that showed an increase in one-year inflation expectations. So in fact, consumers are listening to what the current administration is saying in terms of tariffs. That's could contribute to some front loading, so stronger demand because consumers want to buy all the goods before tariffs are implemented. So things like that will put upward pressures on prices. So we think inflation is going to be sticky for the next couple of years. We don't expect it to get back to the Fed's 2% objective for a couple of years. And again, tariffs will definitely we think will be inflationary for prices.
Let's just put up a tweet by the president, if that's okay. Now, of course, politicians, they can put a tweet up, and especially Mr. T, and, there's no real money behind it or commitment behind it, but he's saying interest rates should be lowered. That would go hand in hand with the tariffs. Let's rock and roll, America. But, of course, I guess past presidents have expressed a desire for lower interest rates as well. Lyndon B. Johnson leaps to mind.
Yeah, but I think also something to note is that the Fed is advanced in its monetary easing cycle. So the Fed has cut rates by 100 basis points so far. And also, there's been remarkable progress with inflation since mid-2022. Inflation was around 8% in mid-2022, and it's at 3% as of January of 2025. So, the Fed is already advanced in its rate cutting cycle, but, we think it's a prudent step for the Fed to wait to see better inflation reports before they cut rates again. And inflation is still too high for the Fed's comfort at this point. It's at 3%. They'll want to see subtle inflation prints over the next couple of months. And they'll also want to just get some clarity on the current administration's policies, right? Tariffs, deregulation, potentially tax cuts, restrictive immigration policies. How are those going to affect the U.S. economy? It's easier to predict what the effect of one policy will be, but when you combine all those policies in an economy, it's harder for the Fed to know what to do with those policies. So, we think that the Fed will be in wait and see mode for the near term, waiting to see what policies are implemented, and then they'll react, once they see the impact on the U.S. economy.
Thank you very much indeed for joining us.